welcome to this webinar, Agentic AI, what VCs are betting on in 2026. So for this webinar, we're going to have a brief intro into some of the trends we're seeing in Crunchbase data, and they've kind of been fascinating. We had a boom quarter in Q1 2026, so we're going to drive through some of that data, and then we're going to introduce our panelists. So just so you know who I am, I'm Jeanne Thier. I'm on the research side at Crunchbase. I am spending a lot of time in our data trying to understand what's happening in venture. And then I spend a lot of time talking to the venture folks, analysts, founders, to understand what they're seeing in the venture markets. So here we go. So this slide is based on Crunchbase data, and it's all the funding going into global venture on an annual basis. And I think the biggest takeaway I get from this kind of venture funding game Steam, and this is every stage, it's seed, early, late, as well as private equity into venture-backed companies. And I think, venture is a growing asset class. It's very clear from 2011. It was globally around 65 billion. And if you go all the way through those years through to 2020, you see venture sort of ratcheting up, not growing every year necessarily, but sort of growing as an asset class and growing globally. I think in 2021 and early 2022, everything was off into the races. We saw 703 billion invested. This was unprecedented. And when I talked to investors across the stack, we saw a lot going into those late stage, very large, $100 million plus rounds. But what I also found is when you talk to seed or early stage investors, everyone was investing at a massive clip. And they were all saying, if I don't invest now, this company could be raising in 6 to 9 months at a higher valuation, and therefore I've missed out, so I'm putting money to work. In retrospect, I think everyone sees that as being excessive. Too much money went into the markets too quickly. You'll see in 2023 and 24, there's a pullback. It's around 300 billion. And I think that 300 billion would have been even lower if it hadn't been for the launch of GPT at the end of 2022. Then fast forward to 2025, funding is beginning to pick up again. I think we're feeling a little bit of that, I wouldn't say excessiveness, but that build-up in the venture markets. We're seeing far more large rounds at every single funding stage. And then Q1, it's 302 billion in one quarter. It's the highest quarter we've ever seen in venture. Much of that was concentrated, but a very big Q1, I think, which stunned everyone. If you look at the funding to AI within Crunchbase data, and what we track is AI, again, this is sort of growing over the years. Everything for us that's in AI is basically AI infrastructure, the semiconductors, the model companies, the data layer companies, and the AI native or application level where AI is driving their business. And I think what's interesting here is AI is not the dominant industry, but in 2025, it was about 50% of capital went into AI. And I think that what that tells me is this is a very different industry where it's kind of weaving through everything. Prior to this, the largest sectors were around the 20% mark. And so this is a technology that is impacting almost every part of the ecosystem. And obviously Q1 is off to the races. Big discussions around the foundation lab companies. Again, you would think, I would have thought in 2024 with all the news that they dominated capital. What we saw is the AI labs raised around 27% of funding to AI in 2024. That obviously went up in 2025 to around 41%, again, not dominant. And then Q1 2026 with the large rounds to OpenAI and Anthropic, the model companies have raised the largest proportion of capital, and most of it going to those two leading companies. This is just looking at OpenAI and Anthropic's fundraising over the years. I think the two trends that we see in our data, which we think it's worth noting. One is the concentration of capital into rounds 500 million and above. And you'll see in 2025 that growing, building up. And then again in 2026, again, very large rounds into these leading companies, into the foundation model companies, also into the automated driving, into data center companies. So much more funding going into the very, very large rounds. I think that's a new feature that we're seeing sort of in this AI wave, obviously because of the cost of compute. And then the other trend that we saw, and this is a trend that actually surprised me, when my expectation was AI is an API call away, this is an equalizing technology, this will be a boom for startups all over the globe. And what we saw instead is a lot more of the money coming back to the US in the last few years, and a lot more of that money coming back to Silicon Valley. So you can see 2010 to 2014, the US is the major market, but it's well above 50% for global funding. That shifts over the next decade where it's below 50%, still the largest market for venture funding, but China comes in, India comes in, parts of Europe grow, and so we see a shift where the US is dominant, but not above 50%. And again, everything skews back to the US from 2024 as proportionally. And I think that's interesting to look at. Is that going to be a trend that will continue as AI becomes more saturated in this industry, or will that then flow back out again? That's going to be interesting for us to watch. This is the SF Bay Area as a proportion of the US. Again, a lot of capital going into the SF Bay Area, certainly not dominant in the prior years, 2025, yes, and into 2026. This is some of the reporting from Crunchbase where we try to report on what we see happening in the markets and talking to folks that are on the panel. So a lot that's happening in the data that's interesting to note. I'm continually surprised. I go in not knowing what to expect, and then you learn all sorts of things when you look through the data. I think it's worth just quickly looking at two quick areas that we're also focused on, the market is focused on, is liquidity. So the exit markets post-2021 have been incredibly slow. What we're looking at here is US venture-backed billion-dollar exits. And I think what you'll see in 2021 for IPOs and SPACs, everything's kind of up and to the right. And that sort of fueled the market. Everyone was saying these companies are going public, they're getting valued up on the public markets. Yes, we should invest because those values, when these companies eventually exit, either by M&A or IPO, these values are going up, and so this is justified. You'll see IPOs fell off a cliff in 2022. We only had $3 billion exits, and that's the price at listing. There was still some SPAC activity, so very slow through 24. We saw 2025 begin to pick up, and when I speak to analysts, what they say is they're looking for IPOs that were sort of in line with what we saw 2018 to 2020. And you can see with $24 billion exits in 2025, things were picking up. And I think the expectation was things would pick up in 2026 as well. That hasn't quite been the case because of the SaaS apocalypse. Some listings got delayed or cancelled. So we'll see what the rest of the year holds. I think there is going to be some very big IPOs that still come out this year. Interestingly, on the M&A front, 2025 was the highest we saw for billion-dollar exits on M&A. And the next slide just shows you the same data by numbers. So you'll see that 2025 for IPOs, ad listing price was well above 2018, but below 2019 and 2020. And then IPOs, the largest value, M&A, the largest amounts we've ever seen in M&A in a year in 2025 for venture-backed companies in the US, and far higher even than what we saw in 2021. Again, down in Q1. So thank you, and I'd love to welcome our panelists to the stage. I'm going to quickly introduce you. If you like these slides, you can download them here, and we'll also share links in the chat. So on the panel today, we have, I'm very pleased to announce Nnamdi Okeke. He's the co-founder and managing partner at 645 Ventures. And Nnamdi's, they're headquartered in New York. This is the seed and Series A investor on the panel, so the early stage, and Nnamdi's been doing this for much longer than a decade. We also have Madison Faulkner, who's joining us from New Enterprise Associates. That's a multi-stage, I think they're 25 billion under management, so very different investor. And then finally, Daniel Doctor, who's the managing partner director at Dell Technologies, and they're a CVC, so again, a very different investor on the panel. So I'd like to welcome you all to the stage. So welcome all. I think to kick off, what I'd love to do is just have each of you intro, your firm, the stage you invest, and where you're focused on investing, because I think that'll help anchor the discussion. So Nnamdi, do you want to kick us off?
Yeah, thank you, Janae, and pleasure to join today. As you mentioned, we invest primarily at the early stage, so seed and Series A. Broadly at seed, we invest between 1 and 5 million, and Series A between 5 and 10. We do have a growth fund, so we can do deals at the Series B and beyond. It's a smaller part of our portfolio. We're multi-thematic, so we have specific research pods within the firm that focus on specific areas. So I spend most of my time in fintech, for example, and Agentic AI is a pretty important inflection for fintech companies. But that's where we invest. We invest globally, so US and international as well, and typically try to partner with founders very early and be really supportive as they grow their businesses.
Yeah. And you're New York headquartered, but you're spending more time in the Valley.
Yeah, we started our firm in New York. We branched out to SF almost 5 years ago, so we have a presence. I'm actually here in SF this week, and yeah, we're growing our presence. Obviously, so much happening in AI in San Francisco and the Bay Area broadly. But yeah, we have two offices, but we do invest across geographies. So wherever we can find great companies, we'll engage.
Got it. Madison, do you want to tell us about yourself and NEA, where you're focused?
Absolutely. As you mentioned, NEA is a multi-stage firm. We've been around for about 50 years now, which is pretty incredible. We invest in all stages. I would say we do generally actually prefer to come in at the seed to Series B. So I actually only invest at seed and Series A myself. And we're only lead investors. So we will write checks of any size at any stage, but then we do stay with the company through the long term, often leading multiple rounds through IPO. Personally, I focus on infrastructure, developer tools, data, AI, agents, much more the technical tooling layer. I also lead our internal data science and AI team, and I formerly used to be a data scientist and AI researcher, leading data science and AI teams at various startups. Spent most of my career at Meta as an AI researcher with FAIR. So love technical founders.
Yeah. And you're fairly new to venture.
4 years. So
Yeah.
it's been a while at this point, but I do really consider myself more of an engineer and AI researcher, and align more with the technical founders than I do with VC, candidly.
Great. Okay. And Daniel, can you tell us about Dell Technologies Capital?
Yeah, yeah, for sure. Janae, thank you very much for including us. It's great to be here with Namdi and Madison on the panel, so thank you very much. Dell Technologies Capital is an early stage venture capital firm, so we focus on seed and Series A's. We predominantly lead deals or co-lead deals, and we're writing check sizes. A seed check for us is $500,000 to sort of 3 or 4 million, and a Series A check is probably 5 to 12 million. So it's sort of the range of check sizes for us. We are a very focused investor. We've always focused on the enterprise. I think across the enterprise, we probably have a slight bias towards infrastructure. Probably 60% of what we invest in is enterprise infrastructure, and the other 40% is enterprise applications. And we've been around since 2012 or 2013, and obviously a very active investor.
Yeah. And I think that's the same time frame from Namdi when you started. So a similar sort of vintage start.
Yeah, we
Yeah.
started in 2014.
Yeah. Okay. So I think where I'd love to kick off, and this is a very broad question, but based on the slides, what I'm seeing is there are these clear anointed winners in OpenAI and Anthropic, and with the revenue growth that you've seen to these companies, you can kind of see why all that money is going into those leading companies and the need for compute. And I'm just wondering how, as an investor, and specifically you, Namdi, and I guess Daniel, well, all three of you are really focused on seed, is how, with these clear winners, they're eating up markets. They're talking about moving into the application layer, not just sort of enabling the companies that are on the application layer, but moving in and competing and seeming to win some very big markets. I think that startups have led in. Everything seems up in the air. Everything is changing with the model capabilities. So how do you, in this moment, as a firm, navigate this kind of seed and early funding environment, given how much is changing? Now,
Well,
do you want to kick us off?
Sure. Yeah, I can kick it off. So having been a VC for a long time, I think there's a few patterns that I've seen. I remember there were times when people described Microsoft owning all the applications on your desktop. This is before SaaS evolved, or Google would own all of e-commerce and internet advertising. And obviously, none of those things happened. And I think oftentimes people go too far to extremes. There's this concept of a kill zone where a company no VC will invest in an area that, a very large incumbent will go into. And I think you're seeing some of that with Anthropic, for example. Our belief is that entrepreneurs are really intelligent and they are strategic and they can think through multiple steps ahead where incumbents may go and may not go. And so we typically defer to the founders' insights around how they think a market may evolve. We're typically thoughtful around where incumbents may go. And, in this environment, you described those companies raising a tremendous amounts of money. But there's a lot of areas they likely won't dominate for different reasons, either because they don't focus there, they don't put resources there, there's structural challenges to go into. So we believe that there's still great opportunity at seed and Series A. We're very disciplined around how we think about ownership and entry price. Our current fund is 200 million, our main fund. So, if a company exits for $1 billion or $2 million, we return our entire fund if we come in at the right price. So we're thoughtful. And I think the last thing I would say is it could be the case that over the next 10 years, the capital needs of companies drop due to the reduction in cost of training the models, companies being CapEx light. So I don't know necessarily that we're going to see the same pattern in terms of a couple companies dominating the way they have in terms of all the capital in the next decade, but I could be wrong.
Yeah. And Madison, how is NEA and how are you navigating this moment?
Yeah, I actually think this is a moment where I'm extremely excited about betting on seed and Series A, especially in spaces that do compete with Anthropic and OpenAI. I think they've really struggled to focus at this point in time, and in doing so, they've been spending so much time trying to win lots of different use cases. And it's wasted a lot of capital when really the only thing that's working is productivity and search-based use cases. For example, OpenAI tried to go into legal for a very long time, battling against Harvey, and Harvey ultimately really won that market. And it was a waste of time. OpenAI also really struggled with Sora and the multimodal video side, and they spent, I would estimate, hundreds of billions on trying to go after that market and finally shut it down. So I think we're going to keep seeing this capital war happen, where they do this incremental attempt to beat each other's model performance over time. And that's going to start to scale out. I ultimately think the success of these companies is more demonstrable of the market value and opportunity. And what's going to happen is a lot of that value will shift out to use cases and companies that are able to really nail the use cases in specific workflows. So I'm looking a lot at specialized models that are very focused on various industries and use cases that have not been very accessible by these models, such as data. I think there's a huge opportunity in structured data. Same with industrial and manufacturing, math, interpretability. I think all of these spaces are not touchable. And there's a lot of hesitation of investors right now to invest in anything that seems to compete with Anthropic and OpenAI. And I think that's a huge opportunity. My company, Factory, for example, is an agent native engineering company. There's a lot of competition with Anthropic and Claude, and they've found incredible success by going up against them and providing a multi-agent and multi-vendor experience.
Yeah. And I think some of what you said, we just saw the Cursor deal was announced this morning with SpaceX, which is going to be a very big deal for them. They seem to have lost some of their market share to Claude, but again, they're coming back because they have a very good product and there's other avenues for them. So I think it's interesting to see how this is going to weigh out. So Daniel, how is Dell facing this very different funding market?
Well, I was just going to comment that, the premise of venture capital or venture capitalism is that we can build something better, or if the founders can create something more interesting and better than the incumbents or the big companies that exist today, whether they're public or private. So, if I didn't feel that way, I would, like I think I said this earlier, I would pick my ball up from the playground and go home. I'm not going to play anymore. But the reality is, this is probably the most exciting time ever to be a builder and to be a founder in terms of how fast things are moving and how much opportunity is being created by this current generation of AI that we're in. So while Anthropic and OpenAI are absolutely amazing companies that are and by virtue of the capital that they've raised, are going to have to go after incredibly large markets, and they will. There's just so much white space around that and in between that, where really interesting founders and startups can play.
Yeah. And I think it's interesting because, we're capturing and watching a lot of the deals come in. And, for a time it used to be mostly software or all software. And I think the incredible thing is it's almost like the data layer is being changed. As you say, there's new model companies coming in. There's so much happening in robotics and physical AI and manufacturing. And then the whole data center revolution and then the application. So it kind of feels like when I cover unicorns, on a monthly basis. It's not in one industry, it's across multiple industries. And so you're seeing opportunities kind of across that board. How that plays out is obviously anyone's guess. I'd love to ask Madison just, we're discussing agentic AI and I'd love to have it defined because I often find I'm in conversations and we're 20 minutes in and I think, wait, what are we talking about? So what is agentic AI?
Yeah. Well, maybe first, let me define the difference between machine learning and AI, because I really started in machine learning, and I would say machine learning is a framing of a problem that can work as a, set of independent variables to predict a dependent variable. And that existed for many decades and continues to exist at scale. And now we saw this movement into AI, which I would say is a collection of machine learning systems at scale that really works as an engineering system. Now we've moved into agentic AI, which is ultimately a collection of systems that can autonomously plan and take multi-step actions across tools, systems, to achieve a task with minimal human supervision. So ultimately, the key properties of agentic AI are the ability to be autonomous, to reason and plan, to take actions, and to adapt.
Yeah. And how far are we, 3 months, 6 months, how far are we into this agentic AI kind of moment?
I think it really came about a year ago. And I mean, ultimately, this is when I made a number of investments in the agent native software stack. And we're starting to see that really monetize at scale. As I mentioned, Factory, they are agent native engineering. And their thesis against Cursor, for example, is that everything should be natively autonomous with injections from humans when necessary to guide. And I think we're starting to see, maybe in the last 3 to 6 months, that major shift from enterprises to be autonomous and agent native as the default, if possible.
Got it. Namdi, I'd love to hear from you because you're in the fintech space. And when I look at fintech in our data, AI is coming in, but it's not the majority of fintech companies are kind of AI native or AI first. It's sort of building into some of their processes at this point. So what are you seeing? What are the strong early use cases you're seeing in agentic AI in fintech or the spaces where 645 Ventures is investing?
Yeah. No, it's a great question. And I do think that data over the next couple of years will change. I think there'll be a much greater percentage of companies that are AI first. There's a few areas we've been investing in. I'll describe some of the most recent deals. We led a Series A last year in a company called Sequence. Sequence is AI-driven billing and revenue management, especially for companies with complex billing models. With AI now, you have a bunch of different types of billing models, usage-based. There may be subscription in there. There may be token-driven business models. So they enable all of that. It's really a step beyond traditional billing and revenue collection. So kind of a focused part of the workflow for the office of the CFO or the VP of Finance. We led a deal in a company called Uptick. Uptick is basically a development platform as well as specific agentic modules for banks, credit unions, mid to large size banks that want to introduce AI into their workflows. That could be loan origination, it could be account opening, it could be kind of providing a loan. So that company is really working with financial services businesses to enable them to adopt AI. And it's interesting because there's a services component. Oftentimes they're coming in and there's a forward deployed engineer that's working with the bank to figure out where they have the biggest needs. And so there's customization there. So those are some of the examples that we're investing in. And I would say to your point, it's still relatively early days for a few reasons. One, there's compliance issues, there are regulatory issues. Oftentimes, financial services firms aren't the first to move and adopt new technology, and there's also a lot of legacy infrastructure, especially at large banks. But we are seeing and investing in founders that are looking to the future and starting to get real traction.
Yeah. And Daniel, from your side at Dell, where are you focused on investing in this sort of agentic space?
Yeah, we sort of look at the AI world in general, as well as the agentic AI world, sort of in three layers. There's the application layer. Um, there's this one of my partners famously calls the messy middle layer, which has all of the developer tooling and the harness and the orchestration and the observability and the alignment and that whole messy middle where there's a bunch of really interesting things going on. And then, of course, there's the infrastructure layer itself, where we think that people can develop really, unique and differentiating infrastructure. And we think about it in that we've actually made several bets at the application layer, in part because that's where I think we can see initial revenue growth, initial very fast revenue growth from real applications and real users. As an example, we have an investment in a company called SKAN, which basically is developing large action models to understand workflows and processes and then optimize and automate those with AI. And then we've got companies that kind of fit into the messy middle part of the world. Something like maybe a super annotate in our portfolio that actually is providing a bunch of data or reinforcement learning data and data annotation for both the research labs as well as enterprises. And then we've done stuff at the infrastructure layer like RunPod, which is an AI software developer cloud. It really makes the entire AI application development lifecycle from training all the way to serverless inference available fast and easy to their, I think they have 600,000 plus developers now. Or a company like Fly.io that has all the constructs for basically what will become the agentic cloud or an agent cloud, which is going to require brand new constructs from what the 10 or 15-year-old public clouds have. So that's kind of how we think about it at a high level, Janae.
Yeah. So I want to switch back to Madison and just, looking at this question of moats. And recently I was at HumanX a couple of weeks ago, and I think what came through from the conference is, and at that time, Anthropic had just made this announcement saying they're moving into the application layer. As I say, they've been very successful with code. We just saw OpenAI, I think, release new image models today, which are incredibly powerful as well. So they're kind of catching up to kind of where the market is and where they need to be. So I guess that my question is data the only moat at this point, or are there more moats which you think, given that everything is kind of being rewritten and refactored, what are the moats for companies,
Yeah.
at this point in time?
Yes, so obviously I come from a data background and have long been a champion for data as a moat. I do think it's oversimplification to say that data is the moat today. I think there are a lot of different takes on moats. And I think if I were to only invest in companies that had some sort of unique data asset, I would miss out on a lot of really great opportunities. I've seen companies that the moat has been moving with the market at a speed that really, really speaks to being frontier, but also bringing in exceptional team members. I do think data can be an extremely powerful moat, but at the same time, there's a lot of opportunities to create and build synthetic data. And so I think at the end of the day, it's about really being in the moment, being intense, listening to the problems and pain points that are existing, and moving very quickly but with quality. So perhaps the best moat today, to be candid, is gross margins. Coming in and really thinking about strong enterprise gross margins as a hypothesis. If you can build a business from the early days where you can try to build good gross margins and expand those and retain those customers, that might be the best approach to a moat.
Got it. Namdi, how are you thinking about moats?
So there's a really good podcast I'd recommend on this topic. Gokul Rajaram did a 20-minute VC a little while back, and he talked about what he called the new moats within AI. And there was several that he talked about and discussed. I'll mention a few, maybe to build on Madison's comment. Workflow, specifically in verticals, we think can be a moat. So if you're very deeply embedded into a company's workflow, where you're doing many different tasks, not to mention you're assembling a proprietary corpus of data that you can train your models on. We think that can be a sustainable moat over time, especially um, um, against the more horizontal foundational models that may not develop that data access as well as the embedding in workflow. We do feel like there's a window to do that. So when we're investing in vertical AI, for example, we're looking really closely around a founder's strategy to really embed themselves in workflow. I think there's other elements, regulatory change can be one, especially in our world within financial services. So deep understanding of where regulatory is going. And so, for example, I'm spending a lot of time in agentic payments and commerce, and that's a category that's very nascent. There are new protocols that are being created. A lot of the large financial institutions are kind of battling to create the protocols of the future, but we think young startups are very nimble and they can capitalize on some of those changes. So, for example, exposure of new data. There's some new protocols around how data can be used with agents. So regulatory can be one. Network effects. It's interesting. On the consumer side, we do some consumer investing as well. There haven't been companies yet that have really capitalized on network effects within AI, but we could see that happening. You could see an AI-driven social network, for example, that comes in and has a new experience for consumers that's really interesting and maybe a step ahead of current social networks. Um, I was talking yesterday with a founder who had a concept around kind of a new version of a LinkedIn that was agentic that could really enable a better experience for a job seeker and an employer. So I think there are a bunch of forms of moats, and I do think actually we're in the very early days for AI companies in terms of capitalizing on them. I think it's going to be really interesting in the next couple of years what founders are able to do.
And I want to add one more moat there. I think another that's new to this era is developer mindshare. I think many new SaaS plays, both on the infra and on the app layer, are very much focused on developer first, which is therefore then agent first. And so much of that means capturing a community of developers, building trust with them, and that trust becomes a strong moat.
Yeah. And are you investing in companies there, Madison?
Yes, that's probably my number one focus. I like to call myself the head of developer relations at NEA. And everything I do is focused on developer community, making sure that everything can be sold to developers and bought by developers and earn their trust. And I think on that note, there is an opportunity to build a more developer-facing social media service. I think GitHub's really dropped the ball there, but we are seeing a few new plays there, such as Entire by Thomas Domke, starting to think about the new kind of discovery and social media network for developers. And I think that could be a major go-to-market channel.
Fascinating. And Daniel, for Dell Technologies Capital, where are you thinking? What are you thinking about moats?
Yeah, so if I just try to add on to the already good answers you've received, we ask a lot of times we ask ourselves when we meet with founders or we ask founders directly, is sort of like what gives you the right to win in what you're trying to accomplish or do. Um, we usually don't believe someone is going to have a better model because if they do, it's going to be better for a brief moment in time. So we're sort of not, it's like, not sure about that. Um, People might have access to proprietary data, but typically not. So the data moat that you asked about, Janae, probably has to be more in the context of, do I know what data matters? Or what data is most important, or what data can help my model climb the fastest and get to be the best. What can I do in my harness that can make me better? Um, and I guess the other question we ask is sort of right to win. In terms of right to win is what is your what's your experiential knowledge of this space, right? So nothing beats a founder that has experienced the problem firsthand and can speak to the fact that I had this problem or I saw this problem and I know how I can fix it.
Yeah. I want to move on to just discussing, this feels like a very different moment with this AI moment. And I've been thinking a lot about potential winners, like, in each market, the fact that Anthropic and OpenAI and Gemini and there are multiple models, and you have the open source models. That's creating a huge amount of opportunity, and no one is dependent on one single company. And I think if you look at any sector like the legal, the coding, people want multiple folks to go to so that they're not locked in. So how do you, Daniel, I'd like to know from you, how do you think of winners in this market? Is there going to be these alpha, one or two or three companies with one clearly leading, or because this opens things up, this market is way more competitive? There's these niche markets which get opened up. There's sort of geography-based concerns as well, which you're selling into. Are we going to see just these alpha winners? Is the power law still going to hold in this market, or are we going to see something different happen?
Yeah, by the way, so I believe that the power law kind of still exists or will exist. I don't think this current generation of AI somehow changes that or makes that different. If I think about the SaaS apocalypse, it's there's a part of me that sort of believes that, hey, that's probably overdone, and to the extent that incumbency and brand and trust still matters a lot for buyers, especially enterprise buyers. Um, However, those companies are going to have to reinvent themselves. They're going to have to be nimble and agile and reinvent themselves with AI. So they're going to have to leverage, to your point, they should be able to leverage this wonderful AI that is available and open. They should be able to leverage this generation of AI to improve their product, to make their product better, and to win by virtue of their brand name, their incumbency, and the fact that customers trust them. And by the way, I'm also super optimistic as a venture capital investor that most of them, or a lot of them, will have to acquire really great startup companies to get to that success point in their product.
Yeah. So you think incumbents have an advantage?
I think the SaaSpocalypse, the
So,
demise of them is sort of greatly over exaggerated at this point in time.
yeah. Madison, I want to switch to you because I'm just wondering, given NEA is multi-stage, and obviously whatever you miss at the seed stage as a firm, you can get in later to the companies that you are hard, and if those companies are valued up, that would look like a sensible take. I'm just wondering, as a company, do you have to have some in coding, some in customer service, some in like all these areas that have taken up legal, health? Do you, as an investor, for your firm more broadly, have to be in every one of these sort of leading sectors and have a portfolio company? Or are some markets missed? And I think tacked on to that, are some of the winners already established? Are some markets too late at this point, even though, as we've been talking about, we're still early in this agentic AI phase?
Yeah, great question. I would say there's always some element of category foresight and trying to ensure that we have a really strong take on a portfolio level as to what categories will have value accrual and make sure that we do ultimately back the winner in that space. I wouldn't say that we necessarily kind of go after having a bet in every single category. I do think we are very thesis oriented and we take a lot of early stage risk in these spaces as well. So it's been very interesting for me on a NeoLab perspective, seeing all these new domain and specialized models that are coming up that are also having one, two, maybe three key competitors. Example being in the AGI for math space, you have Axiom, Harmonic. In material science, you have Cusp and Periodic. In engineering, you have Cognition and Factory. And so I would say we do end up ultimately, we've backed a number of these early stage category defining leaders and creating leaders. But I wouldn't necessarily say that we then chase after companies that are, growing a lot at the growth stages. I think it's really about finding these category creating leaders and having a big hypothesis on why they can win the market from the early stages.
Got it. Okay. So we're going to finish off because we're coming up to our time. And I think where I want to end and hear from each of you is we have a lot of founders who've joined us. And I'd love to hear from each of you where you're most focused. It could be agentic, it could be but where you're most focused investing. Like, where are the opportunities in 2026? What are you excited about? What companies are you looking for that you might not have seen enough of yet? So just forward looking, where are your focus? So who would like to kick us off?
I can jump in and describe a few. One area is what we call AI native services. Maybe to give a couple data points to back that up. So if you think about GDP today, I think roughly 1 to 2% of GDP is spent on software or software related. If you think about services, specifically white collar services, it's like 15 to 20% of GDP. So we're looking at very massive potential markets for companies coming in that are really full stack providers, whether they be full stack insurance agencies, or companies that are basically coming in and providing tech-enabled services that are really high margin, leveraging AI. We think that's going to be a massive category where there's going to be some very big exits. So we're spending a lot of time there, and specifically in fin services and those types of verticals. I mentioned agentic commerce and payments. That's definitely an area of focus. And then banking technology. So one thing I think is very interesting, if you look at the banking software market, there's 4 companies that generate in total, I think 50 billion or so of revenues, and they have market cap, I think, of 200 billion. And I think the average age is like 40 years old or 50 years old. These are very old companies like Fiserv and Jack Henry and FIS. I think for the first time, those companies are vulnerable in a lot of their key kind of core areas. So we're looking for companies that are smart and innovative and want to provide much better products for banks. So those are some of the areas we're spending a lot of time in.
Yeah. Okay. So service driven, reinventing whole industries.
Yeah, AI native services is a big one.
Daniel?
Um, I think the area that's really interesting, and we're seeing a lot, just a ton of really interesting startups in, is the whole reinforcement learning environments and reinforcement learning gyms, and sort of the whole post-training thing that a lot of the neo labs are driving. I think it's a really interesting area. We've made a couple of bets recently. I think there's just so much more to be done there, and certainly we're sort of at an inflection point for that happening right now.
Got it. And for you, Madison, do you want to end us off?
Yeah, so I've been saying this everywhere I go. 2026 is the year of data. And I don't think that we've seen the level of innovation in the data space that is anywhere near as what is required for AI to be successful at scale. We need significant attention around structured data, being able to bridge highly precise workflows and enterprise data back to AI. I think that's the single biggest gap that we have today. And I'm thinking about this both from the BI and analytics side, but also for structured data, context graphs, and ultimately agents for your data, agents for predictive AI, which in some of the early scenarios are looking like foundation models for tabular data. So I'm looking across the whole stack there. And when you think about I guess I'll end us on the magic moment that I had this year. That is probably the best magic moment I've ever had in AI, which was we've been engaging with a vendor called Foresight, which has helped us to build structured data internally at NEA. It's been a huge, many decades long project to do this. We've never made so much progress as the last 6 months. And when I was able to connect that knowledge graph to our Claude and actually ask questions ourselves of our portfolio analytics, all of our companies, our strategy, that to me was one of the biggest aha moments of my career. So excited for the opportunity for structured data.
Structured data plus AI.
Yeah.
Great. Well, thank you to all 3 of you. Thanks to Nnamdi Okiki from 645 Ventures, Madison Faulkner from New Enterprise Associates, and Daniel Doctor from Dell Technologies Capital. This has been great on Agentic AI, and thank you to everyone who joined us. I appreciate this panel, and enjoy the rest of your day. Thank you.